Wealth is built in the speed at which you can move your money and recycle your money. And you have to have a sense of urgency and you have to be quick. And with that, you need confidence. And that only comes from getting over the emotional barrier of that initial property purchase.
The tax system is very complex and a lot of people get tripped up.
Debt is a very interesting word because we are conditioned to think debt is bad. But you have good debt and you have bad debt.
Sometimes you listen to podcasts, you put on 1.2, 1.5, maybe even 2 times speed. This one, I think people are going to have it like 0.8.
With property, and we are property investors, we want to make sure that the assets are as profitable as possible from day one. My advice is utilize companies as much as possible. If you're just starting out, what you need is information and it needs to be correct. So validate and ask as many questions as possible. There's always somebody willing to lend you money, but there's punitive charges because the more complex you make it, the higher the percentage. So the tax system doesn't work. If they spend more on welfare than they collect in income tax, and they know that categorically, they need to have a mechanism to collect more money, and they're doing that through penalties. This is the most important question people should be asking before they buy a property.
Welcome to today's episode of From the Ground Up, and I have got John Noble, tax advisor and the best dressed man in the property space in 2026. Now, there's not many people in life that I can at this point call a close friend. And by the way, before you get upset, that's by design. It's not a complaint. So I have a very small circle of people that I deem to be close friends. Whether we see each other every day or whether we see each other once a month is neither here nor there in true friendship. And John's someone that I would consider to be a good friend and a close friend, and someone who resonates with me in many ways beyond just business personally, and can identify with many of the challenges that we face as business owners, both personally and professionally. And today we're going to talk about tax, because it's not just about what you make, it's of course about what you keep. And if you don't know what you're doing in property, then you're going to make a load of money for HMRC. And so there's no law saying that you need to overpay on tax. So what we're going to look at is how you structure yourself in this day and age if you want to be efficient in property, how you balance that out with being able to get the correct lending. Should you buy in your personal name or should you buy in a limited company? And then we'll move into other aspects of limited companies, how you fund them and also how you pay yourself out of them in the most efficient way. If we get time, we might throw a few little tax reliefs in the mix as well. What I'd like to point out before we get into this episode is John is not only a highly accomplished tax advisor who has his own practice as accountants working alongside him in his practice, Noble One Accountants, but is also a property investor himself. And I think it's very important that when you're dealing with people in the tax space as a property investor, you're dealing with people that actually understand property. John will be the first to tell you, and I'm paraphrasing what I've heard him say, there are 22,000 pages of tax literature in the UK. Did I get that right?
Correct.
Thank you very much. And if you go to a standard accountant, they're very smart people, but they're generalists in much the same way if you go to a GP, they're generalists. You know, you wouldn't go to a GP and ask them for open heart surgery. So if you're in this space, 50 different stamp duty reliefs, capital allowances, specific VAT reliefs, you need somebody who's in this space. John's also the accountant and tax advisor within our academy for our academy members, who's dropping nuggets and gold on our incredible academy members all the time. And so just know you're in the right place. Buckle up. You might want to get a pen and paper. You might want to re-listen to this. You might want to share this with some other people that you want to be tax efficient as well. But before we start dropping golden gems of tax nuggets on everyone and they can collect them in their little golden gem tax nugget bag, who are you, John? But actually, who are you? And I know that question is going to really be difficult for you to answer, and that's why I want to open with it.
Thank you for having me. Thank you for such a kind introduction. You've done a very good job, better than I can do. Who am I? Most importantly, I am an investor and then an accountant, and that is why we are effective at what we do. Because selfishly, I need to know everything in the property space, in the tax space, because that's what I'm doing. And if I'm doing it, and it's a very privileged position to have an accountancy firm, because I see what's working, I see what's not working, I see common errors that are easy to miss, but with a simple conversation, we can save people lots of money by saying, don't do that. One sentence can save people thousands of pounds. And categorically, property is the safest asset class. Typically, you need 10,000 hours of deliberate study to master something. Property is the only thing where you can bypass that by having access to cash, and there's lots of ways of doing that, and using somebody else's expertise. So when you say, who am I? My identity is around showing people how to control their time, remove stress from a stressful life by showing them how to invest in property tax efficiently to give them the means to live life on their terms. That's who I am. That's what I do.
I love that. And that's a fantastic explanation of who you are and what you do. And I love the fact that you say, well, selfishly, it benefits you. And therefore, but why shouldn't that be the case, right? We want to share the things that we're incredibly good at, that we're incredibly bought into. Yeah. If I want to get good at, if I want to become a bodybuilder, I don't. But if I did want to become a bodybuilder, I don't think my joints would allow that anymore. I'm not going to go and hire, I might hire a PT, but I wouldn't hire a PT that specializes in running marathons, right? And I think there is this thing that people don't know what they don't know. They don't realize there's a big difference when it comes to property against just standard tax for a basic limited company that's operating a trade in business. So let's move into the discussion really. I guess one of the big questions that people often ask is, should I buy in personal name? Should I buy in a limited company? Now, as of 2026, where we're currently at, what would be your advice?
My advice is utilize companies as much as possible. Property is less transactions. It's super important, large transactions. And once you make that transaction, you're stuck. So if you purchase a property in your own name without understanding the long-term goal of the property, inheritance tax, personal tax, corporation tax, capital gains, everything. There's so many types of tax. It's so important that you get this advice before you actually endeavor onto buying things. And for 99% of people, and I would say 100%, but of course there is that one person out there who's got no other income. They want 3 or 4 buy-to-lets. They want a very limited amount of income in their own name. Sure, buy it in your personal name. But for anybody who's got additional income, they don't know what the next 5 or 10 years looks like, which is most people, a limited company. And you don't need to have elaborate holding companies and all sorts of offshore companies. A single UK limited company is the best choice for 99% of people.
I love that. And that 1% that you reference, because I've also made a similar point. It's like, fine, if you've got no aspiration to ever be a higher rate taxpayer, if you don't have an aspiration to build your portfolio past the inheritance tax threshold, and you plan to have no borrowing whatsoever, there's a unique set of circumstances where maybe it doesn't matter. However, that very small chunk of people, they're not listening to this because they're not that bothered, right? So the people that listen to this generally want to grow, they want to scale, they want a good income, they want to leave assets behind. And so 99% of the time, I agree, limited company is the way forward. And you touched on a point, actually. I think some people can overcomplicate things unnecessarily. What's the downside of that? So, for example, if I'm going to go, my first ever buy-to-let property, now I've got a holding company because I saw someone talk about it on YouTube. It's a family investment company. It's I'm thinking about putting some of the shares into a discretionary trust, and I'm buying a 200 grand buy to let. What's going to happen with my lending? What's the downs? What happens to my accountancy fees? What's the downside of that? And then maybe we'll move on to when is the time to think about those things.
Primarily, you want to keep things as simple as possible. Always, because you're investing in property now, but you're also a business owner. When you have a business, you want a profit. And the way you do that is by paying less expenses, less tax, less financing costs. Property, you will be using the bank's money if you're doing it effectively. You can property is so safe, you can leverage the bank's money by having no experience, finding a property, saying this is what it will rent for, and putting in a deposit. The banks play a game of risk. If you reduce your risk, and usually by reducing your risk, you're setting up holding companies, you're using trusts, you're making it riskier for the banks. You get a higher percentage on your lending. Initially, your goal is to absorb as much of the profit from the business to reinvest it into the next asset, to get to a point where whatever your goal is, it might be 5 properties, it might be 10, you might have massive aspirations, you want 100 properties, but you need to reinvest that capital. So by keeping it simple and keeping your accountancy fees cheaper, keeping your financing cheaper, by making it as easy and transparent as possible for everybody, once you've got that cash and capital in the business and you've redeployed it and you're satiated to a point, we're never fully satiated, but there are points where we think, okay, this was the goal. We are here now. We need to reevaluate. At that point, and you can always make things more complicated. You can put a holding company in place later on. And tax and property is so bespoke. Some people have kids. Some people don't have kids. Are you planning for inheritance tax? Do you have a wife? How much do you need to pay yourself? Do you have a very flashy lifestyle and you need 500,000? Or can you pay yourself £50,000 and you're happy? It's different for everybody. But for most people, keeping it simple, keeping your costs as low as possible makes the most sense. There are scenarios where it's abundantly clear that having a holding company from day one makes sense because you've got a trading business, it's profitable, you're extracting cash tax efficiently, you pay the rest to the holding company and you redeploy it. But again, these are very specific conversations for very specific people with very specific goals. That's why you speak to an advisor. But keeping it simple is the cheapest way. And by having it cheap, you have more money to reinvest. That's the baseline.
I think keeping it simple is a good rule for life in general, is what I'm coming to realize. Most people don't have an issue with doing difficult things because that's how we're built and designed, and people have done difficult things for years. Most of us just overcomplicate our life too much. And it's a game of subtraction rather than addition. We should take away from things and think what's the simplest way to move forward in this scenario. So one limited company, which we're going to have people at varying levels of experience listening to this, is made up of shareholders who own the company, a director or directors who legally are responsible for the company. Often that might be the same person. And I guess then there's going to be other people that this might be relevant for. 2 questions then. Let's do the one at a time. My first one is, if you are going to go and get your accountant or tax advisor to implement one of these structures, e.g. holding company, e.g. family investment company, how important is it that you actually understand fundamentally what it is you're asking them to do? And I say that because sometimes I see people who hear something, don't really understand what it is, and then they're going and trying to set it up. How important is it they take the time to understand what it is? You must get this, right? I get people come to me and say, hey, I'm thinking of setting up a holding company. And so I ask them a very specific question. I ask them every time. I say, what's the benefit that you're hoping to get from that? And 9 times out of 10, they go, what is it you're aiming to achieve with it? And so I'm like, okay, well, when you can answer that question, maybe then it's time to. So, how important is they understand what it does before they just go and get an advisor to set it up? And then the second part is, at what point, could be the threshold, loosely speaking, for people to think about this?
I am very direct with how I speak to people now. People pay me to remove stress. And when people have unanswered questions, they have a stress. So what we do is we listen to them. I don't ask questions first. I listen to their circumstance fully. So instantly, I know what they need. And then I just tell them, I say, you don't need this because of this. And then I leave it there. We get asked to set up holding companies every 2 or 3 days. We would make more money by doing that, but that's not our goal, because in business, it's all about longevity. It's about having integrity. We're not trying to be paid now. We're trying to be paid forever. And the way you do that is you're a good person. You're playing the long game. If you do a very good job, you'll have income forever. It'll be very easy to say to all of these people, here's 3,000 holding companies. But what we do is we just listen. It's all about listening. And instantly, we know, and it comes back to keeping it simple, we know that your financing costs will increase. With a group, there's something that people easily overlook. You have a pool of lenders, and the easier you make it for them, you have the cheapest pool. There's always somebody willing to lend you money, but there's punitive charges because the more complex you make it, the higher the percentage. Even if you have a group, if you have different directors on different companies, that can make it extremely hard for financing. Everything is about leverage with property. When people have trading businesses, and this is the most common reason for having a holding company, I have 2 investment companies. I have a group, which is with my trading business. And the way that is set up is we have the trading business, we have Tilly and myself, we have staff, we extract as much from that company as tax efficiently as possible. We never want to be paying a higher rate of tax. And that's what a limited company allows you to do, control what you pay yourself. But then rather than leave all of the profits in the company, you can pay it to the holding company as a corporate dividend. And a dividend is a personal tax, so there's no tax to pay on that. Not only have you removed the profits from your trading business to the holdco, it's safe because you've made a legitimate dividend. You've declared that dividend. So if something were to happen to the trading business, your hard work is saved. It's like when we were kids and we played PlayStation. You'd play for an hour and you'd save the game. You'd play for an hour and you'd save the game. It's the same in business. But a lot of people don't do this. They have one single company that is super profitable because if you're making £100,000 in a single company, well, then you can extract that tax efficiently. You can pay you and your spouse £100,000, small salaries, the rest in dividends, and then you can introduce that to another company. That's a simple way of doing it. But if you've got lots of excess profits and you've got the ambition to have lots of other ventures, possibly joint ventures, different types of property investment, you might maybe want to trade in a very similar niche with your skill set now and your staff, but you want to mitigate the risk, you'd have a holding company. But again, that's probably 5% of people. Most people have cash. They've inherited it and they don't know what to do with it. Single limited company. They're divorced and they've got this windfall and they don't know what to do with it. Single limited company, directors' loans. Trading business, potentially a holding company, but it's a potential. With groups, there's things such as group loss relief. If you sell a business, it's super tax efficient. But again, this is all less than 5% of people. And that is when you need to speak to the person because somebody may tell you briefly, oh, I'm thinking about selling my business. But then you actually speak to them, you get the details, you get the actual numbers, and you think, well, actually, there's a better route. And this is, so you need all of the information from people. So holding companies are a fantastic way to mitigate risk. But again, with property, and we are property investors, we want to make sure that the assets are as profitable as possible from day one. That is the key. Family investment companies can be introduced later on. And they usually are because they involve families, which involve minors, which involves trusts. You do that later on.
Nice. And so, okay, we'll pick up on family investment companies because I think it is an interest. And don't get me wrong, I think it is an incredibly useful thing for people to be aware of and to know that it's an option available. But I guess if I summarize to an extent what I believe you said, because I also don't want to put words in your mouth because it's not explicitly what you've said. At the beginning, you should focus on making as much money with as minimal costs and keeping as much profit.
Yes.
As you grow, by default, or not even by default, but then the benefits of these start to outweigh the cost of these potentially.
Of course.
So, and again, certain circumstances, if you've got a highly profitable trading company and you're not wanting to send loans across, but you want to keep things really clean, maybe it's going to be useful to you. But initially, keep it simple, focus on profit.
Preservation later on, profit initially.
Correct, yeah. And so mitigating risk or dialing down, it's the same as gearing, right? You borrow a lot when you start out in property. Once you've got a large portfolio, you naturally want to drop your overall gearing and your overall borrowing down. And what you're really doing is dropping your overall risk down. And you've now got assets that you need to protect your estate, which then leads me on to family investment companies. So that people, I mean, what is the inheritance threshold? Thinking about, and there's obviously a couple of circumstances. If somebody's married and including their residence and not including their residence, at what point do people need to start thinking about the threat of inheritance tax?
Sure. And people avoid inheritance tax because people don't like thinking about death, but we need to think about it. In the UK, each person has your nil rate band. It's £325,000. That includes cash, assets, cars, watches, all of your worth. £325,000 is tax-free. If you are married or in a civil partnership, that is doubled. There's two of you. And then also, if one of you passes away, you inherit that from the other person. Another key thing to make this more tax efficient is the family home. The family home, and it has to be a family home that you live in, it cannot be a property you own, is included in that at £175,000 per person. So altogether, this comes to £1 million that you can pass on tax-free, assuming the home is included. But the thing with property, and the reason we invest in property, is you may purchase a family home 20 years ago and it's £500,000. But when you die, the same property is 1.5 million. Your assets, if you're doing it correctly, are always going up in value. And that's why we invest in property. So £1 million might sound like a very large amount of money, but these tax thresholds have been frozen for so many years. That in itself is a stealth tax.
This one
5 years ago, and it doesn't reach the headlines. People don't understand it. Oh, you've not increased tax, so we're okay. But by paying you more money, by the property assets, by printing money, inflation pushes the asset prices up, more people are being caught by these tax bans. Huge, huge manipulation of information for the masses. We're not putting it up, but we are just going to leave that there for another 10 years. You get paid personal allowance of 12,570. Next year, that'll probably still be the same, but you're being paid more. The next year, it'll probably go up by £50, but you're being paid more. Oh, we've just printed all of this money that's going into circulation. All of this is deliberately complicated. And the goal from not to become conspiratorial, but the goal is to collect as much of your cash as possible. And this isn't taught in schools. It's not taught in schools. And if you pay too much tax, they won't give it back to you. Most people pay too much tax. Most people are collecting all of their income in their own name. Most people aren't utilizing investment companies, trading businesses, holding companies. Most people aren't employing family members who don't have an income and who can benefit from being employed from the company and being given a role so they can learn about the business, which actually helps you make more money because you can bring them on and they can contribute all of their knowledge. All of these things, you will not find a book that goes through all of this and it says this is what you should do. It's not taught. So inheritance tax especially is a really, really high 40%. Think about that. You pay tax, you earn money, you pay tax, you sell an asset, you pay tax. You have this wealth to pass on to your kids and then you die and it gets taxed at 40% if it's over that threshold.
It's a killer. It doesn't take much in property to build multi-millions. It sounds like a big reach for people in their mind, but as you say, property, you walk down one street, you walk past millions of pounds of property. It doesn't matter where you are in the UK, really. As it currently stands, 93% of landlords own property in their personal name, so they're an easy target. I think you touched on interesting points. It's almost like the game is now tax people in a way that they don't even realize that they're being taxed. Because if they turn around and said, which I have done for landlords, right, we're going to add another 2% that comes in next year. But if they turned around and just said, hey, rather than 40%, we're going 50%, that's different. But it's so easy to say, well, we're just freezing the thresholds. And that goes over most of the population's head. I think inheritance tax frozen until 2031. And it is a stealth tax. And it's probably one of the worst taxes, these freezes. But it's because it takes 2 steps to understand it. People just write it off and don't take the time. So the fact that property is going up means more and more people are under that or over that threshold, should I say, and more people are getting caught out. £1 million in 5 years in 2031 is not £1 million today. And so it is as good as taxing people more. It's the same outcome, but people don't resist it as much because it doesn't feel like it logically in their brain. So once we're over that £1 million, assuming we're a married couple, including the personal home on top of the nil rate band, at that point, would you say it might be, if the plan is to continue growing and building a portfolio into the millions, would you say at that point it might be worth considering things like family investment companies? And could you give an explanation on what, because some people are like, what the hell is the fact? Is this some different type of company? Obviously, a limited company. What's the difference? What constitutes a family investment company?
Sure. Going back to personal name or limited company, this is the reason we're investing in limited companies, because you have the flexibility to do these sorts of things. When it comes to inheritance tax, people overlook the strategy of lifetime gifting strategies, which plays into the family investment company. If I give my son £10 and I survive 7 years, that's outside of my estate. If I give him £10 million, it's the same, it's outside of my estate. And after 3 years, you start seeing a benefit because it goes from 40% and it reduces by 8% and 8%. And after 7 years, there's no tax to pay. This is inherently why family investment companies are useful, because limited companies own the properties, but you can own the shares. And the shares can be changed. You've got dividend rights. You can freeze the value. You can have growth shares. You can have voting rights. You can benefit from certain parts of the company. You can control the company, but the future economic value sits outside of your estate. And in the simplest way possible is because you've gifted the value via the shares. A tax advisor, a solicitor will do this for you. You don't need to understand all of the idiosyncrasies of exactly what they're doing. But if you just understand that if you gift something to somebody and survive 7 years, well, then that's outside of your estate. A caveat to that is then it's in somebody else's estate, which is another part of the equation. But this is why when you have comprehensive IHT planning, they look at everything. They look at where you'd be living in 10 years, 20 years. What if the kids get married and divorced? Can you use gift trust? Can you use bare trust? It becomes very elaborate, but at a certain point, this should be done.
And so it's got to be bespoke. You can't just go and say, right, I'm going to issue my own classes of shares and set this whole thing myself. Go and get the right advice and plan the whole thing out. So a few things that you mentioned there, you can have different types of shares. So if I want my kids to be part of the company, they can be shareholders from any age. Fine. I can have voting rights, dividend rights, which means I control the company. I can get paid by the company. They effectively have future economic benefits. And so rather than you just gifting someone the whole thing, what we're doing is we're, I guess, moving value over time in a way that means that when I do die, we're all going to die. So if you're putting this off, I'd hate to be the bearer of bad news. Unfortunately, that is going to happen. And depending on your beliefs, that might be the beginning. So otherwise, it's going to be a potentially exempt transfer. If I give 10 million to the kids, well, one, I lose the benefit of that as well, right? So I don't have control anymore, and I don't have the ability to pay myself, right? So that's where the share classes can matter. And as you say, there's a steep drop in what you pay tax-wise after the first few years from 40%, and it staggers down, right, into zero. So that's good, and that's important. And so after people are sort of pushing over the million mark, because you say we can backfill that, you can, or I guess if someone's got $1 million here, they can start building a separate company. And
there's lots of different ways to do this. So the £1 million isn't the value of the property. It's assets minus liabilities. And it's very easy to get a mortgage against property. So if you've got £1 million of property and you've got no mortgages, you've got £1 million worth of asset. But if you have a £500,000 mortgage, which is common, and that's a nice loan to value, you have £500,000 of value in your estate for inheritance tax purposes. If you have a large director's loan, which means you set up a limited company, you took your cash and you just introduced it to the company, well, that money's owed back to you. So typically what people do, and that's very common because you need money to invest in property, what people do is they mortgage, gear up, get some money from the bank. That reduces actually what they own of the property on paper, even though you benefit from all of the uplift in the value. And they may pay themselves back the director's loan, and then they can simply gift that to kids or spend it on experiences or go and buy a property in a different country. It's your cash. You can do what you want with it. But the underlying theme of inheritance tax is the gifting route is easily overlooked. And you should look at all of your options to utilize gifts. And then at the higher level, you've got family investment companies. But most people might be owed 300 grand from their company, and they don't know they can simply refinance, take that back, and then pass it over.
Yeah, makes sense. Makes a lot of sense. Which leads me nicely actually on to when you set up a limited company and you want to put funds into that company, what are the different ways that people would fund a company?
This is the most important question people should be asking before they buy a property, because this changes the entire potential structure that you'll be using. It depends on the people involved. Is it a family company? Do you have business partners who you don't trust, but you're going to business with? All of these things, lots of joint ventures are potentially with strangers, and you have a shareholders agreement. All of these things make a difference. Option one, which is the most common, is you as a person have cash. It's already taxed. It's your money. It's in the bank. You could refinance your personal home. That's your cash. You could have already taxed money from a job. You've got personal cash. A limited company is this elusive thing where people think, oh my God, like they've got a company. And again, this comes back to it not being taught to us, but it's very simple for a company to be set up. It's a separate legal entity. It is not you. You own it via the shares. You control it via the directorship. Set up a limited company, take your cash, put it in the company, and that just means setting up a business bank account and transferring the money across. That sits there as owed back to you. I always want to keep things as simple as possible. This is the simplest way of doing it. This is how I've invested in one of my companies where I had personal cash. I've taken the money, I've set up a company, I've put it into the company, I've purchased property. Every pound that portfolio generates, I can pay myself back tax-free. It's not a salary, it's not a dividend, it's not interest. It doesn't mess around with my personal tax planning because I'm repaying a loan. However, the money that I put in and then purchase the properties with, I own all of that property. And I also am slowly taking all of my cash back. So say I put £500,000 into the company. After a while, you can have 500K's worth of property and the money back. Super simple. That's a really good way of doing it. Another next level up would be somebody's got a business. Doesn't matter what the business is doing, but it's got funds in the business. Because the limited company is not you, getting money out of the company is one of the challenges. This is where the tax planning comes in. But typically people will pay themselves a salary, a dividend. They will utilize the company for as many costs as possible that are legitimate. And legitimate is the key word there. There's lots you can do, but you need to know what you can do. But then you might have £100,000 sitting there. You can simply do a company to company loan. And that would be an asset and a liability because it's money owed and owed back. This needs to be managed. Very common way of starting, but what you don't want to do is build up a massive company to company loan because trading businesses are volatile. They are guaranteed to run into some sort of issue because there are so many types of issue. You could be sued. Somebody could walk in your premises and slip over. You might have cash flow issues, COVID, just all of these random events that you just cannot plan for, but you know they're coming. So if something were to happen to your trading business, which is inherently there to generate an income, generate a profit to be used as save points, if there is a massive company to company loan, well, then that might have to be paid back. And if you've used that money to purchase property, which is an illiquid asset, you can't simply sell a property. And if you do, you've undone your hard work. Company loans need to be managed for that reason. Because when you invest in property, property gets better and better with time. We are guaranteed to have capital appreciation in the long term. It might not be year 1, year 2, year 3, but it's pretty much guaranteed by 5, 7, 10 years. And cash flow, we invest for cash flow. So the cash flow covers all the costs, so we hold on to it. If we're forced to sell it at any point, it's not a very good plan. So company to company loans are effective initially, but they need to be managed. Thirdly, holding companies. Same scenario, but trading company A is owned by a company that you own. You can pay the profits here. That's safe. If something happens down here, it's an isolated risk. Intercompany loan to the SPV, the special purpose vehicle that's purchasing the property. Risk. You've mitigated your risk. That can sit there for 50 years, be inherited. That can be sued and be dissolved 5 years later if needs be. But by having the mitigation of risk, it allows you as a business owner to make calculated decisions, knowing that your worst case scenario isn't a reset. And the number one rule in business, doesn't matter what you're doing, is you have to avoid catastrophes. You make money, you put it into a save point. You make money, you put it into a save point. It doesn't have to be property. There's lots of save points. Family homes are save point. Assets in cash, watches and cash. It's all save points because you can get the money out. But if something happens and you lose all of that hard work, it's not very good business.
Awesome. So avoid catastrophe. Write that down. there were, I counted 3 ways there to fund a company. One was director's loan, one was company to company loan, and one was via holding company structure. So the latter, from an accounting perspective, is arguably cleaner than company to company, right? And then goes back to, is it the right time? Well, depends on other confounding variables. What's your lending setup? What's your current portfolio? What's your aspirations? Who else is involved? Company to company, fine, but know that that's going to stand out on the balance sheet until you've actually repaid it. Otherwise, you can't get rid of that trading company. And should something happen, you're going to need to pay it back. That's something to be aware of, because you're now spreading the risk of your trading company into effectively your investment company, I suppose. You're sharing that risk in both. And then the first one was director's loan. I'm going to pick up on that one because I feel that a lot of people get this back to front in their minds. And so I hear a lot of things misquoted to me about director's loans. As I want to open that one up. And this is quite common, right? Somebody refinances their personal home, goes and puts money into a company. Somebody has that divorce that you mentioned. Somebody has inheritance, puts that money into a company. So this one's quite common. I guess I want to open up the fact that director's loans go both ways. Because when I say director's loan to people, they've often heard about borrowing money from their company. And they start talking to me about, well, if it's over £10,000 and it's got to be paid back in this amount of time, otherwise it's going to be a dividend. And there's all of these misconceptions. So I guess what I want to do is make a distinction between you as a director lending money to your company versus you borrowing money from your company. So to simplify this, because so many people, I'm guessing you might have seen this as well, so many people get this back to front. If I am lending money to my company, when does that have to be paid back?
There's no time frame.
How much do I have to charge in interest?
You don't have to charge interest.
Fine.
And most of the time, it's not a benefit to do so either.
Perfect. And that, I wanted to make it so simple for people that way around is actually ridiculously simple. Now, borrowing money from a company, not different. So simple, right? So less common. I mean, I don't know about you personally. I don't tend to borrow money from the company. It's not that I've never done it. I have, but usually on a very short-term basis. But if I want to borrow money back from my company, let's say I've got 100 grand in a trading company, I personally want to borrow it. And this is the bit that people get mixed up with. What do I need to watch out for then?
Sure. The company is not you. And the company can owe you money or the other way around. So the first part that you've covered, you can put any amount into the business. There's no limit. You can pay yourself back in any increments over any timescale. Typically, let's use the example of a single company with a single shareholder and it's your money, because of course, if you've got 3 or 4 directors and 3 or 4 things, but the principle is the same. Putting money into the company, no limit. You can pay yourself back whenever you want, really tax efficient, flexible way. The caveat is that you've had to pay tax somewhere or you've got that money from somewhere and you're just utilizing it in the company. When the director's loan goes the other way, there's a few things to look out for, but it depends on the scale. You can credit your director's loan account, which means you're putting money in or you're selling an asset to it. Or if you're claiming mileage, this is a good example. If you have a personal vehicle, you can now claim 55 pence per mile. So if you do 10,000 miles, business miles in your vehicle, well, you can claim £5,500 from the company. How do we do that as accountants? Well, we will do a journal, which is an accounting journal, where that credits your director's loan account, which means you can take that money from your DLA, your director's loan account, tax-free, putting money into the business. These are all things that credit it. When you take too much money from the business, you debit it. It's overdrawn. Different thresholds here. So the first thing your accountant will do is look at the amount and then look at things such as mileage. Do you have retained earnings? Because if we declare a dividend and you don't take the cash physically, credits the DLA, brings it back. Salaries. Director salaries don't have to be paid from the business. HMRC say once that payment is credited to your director's loan account, it is classed as paid. So lots of people, this is a common mistake, people set up a limited company. It's not doing that much from a turnover perspective yet, but they don't have any other income and they don't declare their salary. Every year you get £12,570, which will be frozen for another 5 years possibly, but you get that amount tax-free. So you can set up a PAYE scheme in your limited company and pay yourself for the work you're doing in the business. That gets credited to your director's loan account, which means you can take that at a future date tax-free. And if you don't do that before April each year, you lose that. You completely lose it. But these are the things your accountant will do to bring back your overdrawn director's loan account. If at any point in the year, your director's loan account goes over £10,000, it triggers something called a benefit in kind. And there's a few ways to deal with this. You can pay yourself, the company's not you. So you can pay the company interest at the official rate to remove the benefit. So you have received a loan, you've paid interest on it, you haven't benefited. Or it gets reported on a P11D. But what your accountant does is they check retained earnings, mileage, anything you've sold to the company, any existing credit balances that are brought forward because it's a running balance. And the goal is to keep it under £10,000. Director loan accounts need to be repaid 9 months and 1 day after the company year end. And all companies have a different year end. So you could potentially borrow £5,000 from your company and pay it back within 9 months, and there's no benefit in kind, and you're okay. But again, all of these things such as debt need to be managed. If you have a massive overdrawn director's loan account and it's not repaid within that time, there's something called S455 tax. It's a withholding tax. HMRC will tax you, it's going up to 35% of the value of the overdrawn amount, but you get that money back. But there's 3 things here. You may pay it to HMRC and you may repay your loan, but they're not very quick at giving you the money back. So it affects your cash flow. It's a withholding tax because what typically happens is people have a massive overdrawn director's loan account. This is more with trading businesses than property, because to invest in property, you need to put cash in. People look at how much money they need to pay back to the company, realize it's got limited liability, and start looking at routes to potentially close the company. Completely different conversation. So HMRC say you need to pay this withholding tax that we will repay to you just to make sure that you stay around and carry on trading. But they're the 3 levels. So below £10,000 has to be repaid 9 months and 1 day. After £10,000, it can trigger a benefit in kind. If you cannot repay it, you don't have retained earnings, you've got no other cash, it can trigger a very large temporary tax bill, but a massive tax bill.
That they're not going to hurry to pay you back.
No.
So that's where we've got to be mindful. And for those of you that are thinking strategically, just a warning, you can't just pay it back and then take it back out, can you? Is it bed and breakfasting?
Bed and breakfasting. So some people like to do it a day before and a day after.
Yeah. HMRC will pick up on that one. So if you're thinking, do you know what I'll do? I'm going to borrow money from the company. Just before that 9 months elapses, I'm going to pay that money back in and borrow it back out the next day. That is a surefire way to get caught out. So don't do that. So, okay, fine. So as you say, to be fair, in property, more times than not, we're lending into the company rather than borrowing from the company, at least us personally. And another point I want to pull out that you mentioned is you can withdraw anything on your director's loan. So let me simplify this and contextualize it for people. I got £100,000 from pension, drawdown, whatever. I put that into my limited company. That forms a director's loan account. Now I buy a property, that property makes money, maybe it's making £2,000 a month. I can take out that whole £2,000 a month personally with no tax personally whatsoever up until the point that I hit that £100,000. I should still pay a salary based on what you've said, so take that on board. The bit I think I want to pick up on, because you'll always get someone in the comments, you will have had this, right? You'll always get someone, you know who you are, you're ready, you're probably there right now. You probably already wrote it and you're going to delete it in a minute because we're covering it. Who goes, well, it's not tax-free, right? Because you pay tax in the company. And actually, maybe not, right? It depends how you get those funds back. Because if I go and buy a property, do the property up, refinance the property, then there's not a tax for that because I'm borrowing against, right? Mm-hmm. So I'm just repaying money that, and I think in people's mind, it's important to separate personal tax and company tax. Because yes, you might make profit in the company in the scenario that I described, pay corporation tax between 19 to 25%, and then you don't pay personally any tax on a loan withdrawal or loan repayment. However, it's not always profit, is it? You can increase the value of something, borrow against it, and then there are no taxes either side. But I don't know if you've ever had that, but when you do a 60-second video on Instagram, it's very hard to convey every single point, although the point stands. there is no tax to pay personally. And you were very clear on that, but I want to highlight personally. There may or may not be in the company, depending on where you've got that money from, whether it's profit, whether it's not. And I think it's so important to separate those two. And this is where the tax system is very complex. And a lot of people get tripped up and they go, oh, it's too much information. Stick with it, because this is a massive part of being a business owner and investing, is knowing what the taxes are, how they interact with one another. So you've got your personal tax, which might be your income tax, your dividend tax, your national insurance, all of these types of things. And then you've got your company taxes, which is often your corporation tax. And so let's talk about getting money from the company. It seems like a natural progression on from where we are. So aside from just repaying a director's loan, how else can I extract? Because one of the benefits of having a limited company is it's not rigid in how I'm paid. But I guess one of the things to keep in mind that you have to then be considered in how you go about paying yourself. Because if I've got a salary, I pay income tax, national insurance, that's the end of it. Depending on what I get, it's very straightforward. In a limited company, what are the different ways? And I'm talking everything from pensions to dividends and broadly speaking, in 2026, for the average person, what might be a good combination to extract?
Sure. Different options. The salaries. So if somebody's not utilizing their salary, pay it through the company. This has become less advantageous than it was previously because national insurance has increased. But by paying the national insurance, by paying the salary, you get more of a tax saving from the corporation tax. If you're a sole director, that is. If you have one or more, if you have two people or more on payroll, you don't pay any national insurance. So the first thing, and again, just try and keep it as simple as possible. Just think of it as a salary. If you're not being paid from anywhere, make sure you're being paid through the company. People naturally think money needs to exchange bank accounts. It doesn't. Make sure your accountant is declaring the salary. Next, we have dividends.
Before you jump on, I'm going to pull on some points because I know what you mean. I know you know what you mean. I just want to pause because I don't want people to misunderstand what you mean. So you said when you got two or more people, you don't pay national insurance. We're talking about national insurance allowance. So we're talking about
employment allowance.
Employment allowance. How does that work? Because it doesn't mean just because you've got more than one person, you never pay national insurance. Right? I just want to highlight very quickly, there's a cap on that, but you're talking about obviously taking the minimum threshold salary, but just before anyone goes, well, I'm going to pay 100 grand, no national insurance.
Yep. The company isn't you. So when the company pays a salary, you have employers' national insurance. If you have two or more people in it, and that can be directors too, you get the employment allowance, and it's £10,500. So for smaller companies up until 5 or 6 employees, that covers your national insurance. There's nothing to pay. Well, you pay it, but it's claimed back. Mm-hmm. So that's key. Even if you are a sole director and a sole shareholder, still paying that £12,570 is still tax efficient because you save more in corporation tax. You pay £1,100 in national insurance, but you're paying national insurance at 15%, but your corporation tax is 19 to potentially 26.5%, depending on your profits. But if you have two people on the payroll, it's even better. Salaries have to be declared within the personal tax year, which is April to April. Can't backdate them. That's the key thing here. Next, the next slice of the pie is dividends. Dividends have to be paid from profits, company profits. And one of the benefits of investing in property is lots of the time your company can be in a strategic loss. Mm. So dividends are only paid from profits. That's key. Another thing, because we're property investors, you need to look at your financing. Everything comes back down to financing. Is there a certain amount of income you need to declare for your investment properties? Mm. Typically, £25,000 covers absolutely every lender. Some lenders take 19,000, some 22, some. Speak to a broker, have a good broker before you know if you know what you're going to be purchasing. Say, I'm purchasing this 4-bed property in this area. I'm a company director. How much income should I be paying myself? Because we pay strategic salaries sometimes to directors, knowing that the salary is an expense, so it reduces corporation tax. They might pay a little bit of personal tax, but it keeps the banks happy because you have income. And if you have income, you're less likely to move into the property and you're less likely to do things that worry the bank. So the salary is important. 12,570. Utilize your family. You can put your kids on the payroll if they're 13, 16 or 18, depending on hours and council permits. But teach your family about the business, give them an admin role, give them emails to do, get them to go and look at properties, get them to do Rightmove research, get them to edit your videos, and then pay them. And you can pay them 12,570, even if they're 18, because what HMRC say is the salary has to be representative of the value and work done in the business. We're not paying £70,000 salaries for people doing 3 hours a week. We're paying the bare minimum, which is tax advantageous for you. They get their pocket money. It's a very nice way of incorporating the family and being super tax efficient. I'm a very big fan of the family company, the family unit, because there's not too many ways you can be super tax efficient now, because HMRC look at everything and they close it down. But each person has their own benefits. So each person can be paid £50,000 a year and be tax efficient. And if you have 3 of those people, that's £150,000. Big difference. You've got kids that might go out and get a job because they're 18 and work for somebody else and not really enjoy what they're doing, or you can teach them and pay them at the same time. No better thing than that. So dividends, salaries. Interest is an interesting one. If you introduce capital...
Was that a pun? Was it intended?
Yeah, very interesting. Interested, yeah, you've got me here. Paying interest on a director's loan, 95% of the time doesn't make sense if you've got any other income, because you're creating an expense in the company, but then you pay personal tax. And again, if your company already has losses to carry forward, you don't get the immediate tax saving. So we want to control what we pay ourselves personally, always. Always. This is why sole traders move to limited companies. This is why people invest in limited companies rather than their personal name, because once that income is being paid to you personally, you have no control. And control and ownership is what we need to make prudent, good decisions and to build good portfolios. It's about the small savings along the way that compound and then allow us to get to wherever our goal is. And being paid personally gives you no control. If you're a PAYE salary, you get taxed and then given what's left. If you're a sole trader, you get the money, but then you have to declare everything from April to April. You can't strategically declare dividends. The corporate ecosystem, limited companies are how we control that. So paying yourself interest from the company most of the time doesn't work, because you might save 19%, but then you have to pay income over here.
Makes sense. I think there's a personal savings allowance, but it's so nominal and it's based on your income, as you say, unless you got no income from elsewhere. So, okay, so you got salary, which is what a lot of people would be familiar with from the working world. You can pay your salary. You're saying, take that minimum 12,570 as a salary. And if you've got more than one person, great, you can get some national insurance saving for the employer's side of things as well, which is brilliant. You've got dividends, which, to highlight some key points that you made, can only be issued on profit, right? So if you are declaring a loss in your company, you can't go, right, I'm going to pay the rest up in dividends. No, you can't pay any dividends, right? That's not an option to you. That's the trade-off that you've got. So maybe in that case, someone pays more salary. Worth noting that the salary then is an expense to the company. There's no corporation tax on any amount that you've paid as a salary. Dividend, then you pay tax both sides, right? So I'm going to pay corporation tax on the profit in the company, and I'm going to pay tax personally on the dividend when I take it out. And that's going to go up depending on how much I'm earning. Now, you mentioned the rates of corporation tax. You're saying 19 to 26.5. So we're talking about the marginal rate. For those that don't understand corporation tax, a two-part question. One, just very simply to help people understand, at what point does it go from 19? When does that 26.5 kick in? When does it go back to 25? And second part of that question, because a lot of people miss this, how do associated companies affect those thresholds?
Corporation tax. First example, let's assume you have one company. The first £50,000 is taxed at 19%. 19%. At £250,000 profit, it's 25%. But the way we get to the 25% is every pound. People overlook this. Every pound after £50,000 in profit, you're taxed at 26.5%. So when you actually look at your company tax return, it will say 21.6% or 23.4%. But the first £50,000 is taxed at 19%. Big difference to 26.5%. So you want to, and you don't want to reduce your profits. If you're trying to be as profitable as possible, tax is necessary. If you pay lots of tax, you can go to the bank and say, I'm super profitable, give me more money. It goes both ways. But if you're just over that £50,000 mark, you need to be conscious of the fact you're paying 26.5%. That's the best case scenario, sadly. Associated companies, so you and I have a company, but then we have another company, we're associated. Your £50,000, it's called the small profits threshold, is cut in two because you have two. If you had 3 companies that are associated, and that's from the control, the shareholdings, it's divided by 3. If you have 4, it's 12,000, So don't have unnecessary companies. If they're dormant, they don't count. But the way they work it out is within the trading period. So you'd have to make sure the year ends are aligned. But essentially, if you have companies that are barely being used, they could be costing you additional corporation tax, because either you're paying 19% at 50k profit or 19% at 25k profit, or it gets divided by the amount of companies. This is a relatively new thing. 2023 it came in. HMRC have typically a very archaic, slow system, not very efficient. That's changed in the last year and a half because they've partnered with these big AI companies. And now there's lots of automatic notifications to HMRC. So where previously they would employ somebody to look through everything and they'd go and find all of the big fish to go and make their money from. Now, if your associated companies is incorrect, you automatically get a letter. If you're submitting a company and you've not declared VAT, well, the AI picks up the turnover and you get the letter. So these things are super important now.
How many letters have you seen over the last year?
You'd be absolutely shocked at how much post we get from HMRC. So if you're a client of ours, your company's registered at our office probably gets 30 to 40 letters a day, not all saying punitive things, but things. SIS, payroll, associated companies, VAT, council tax letters. People don't pay their council tax. We get a big part. Admin is a massive part of my business. We get thousands of letters a year.
It's actually a really interesting thing because I guess this is easy wins for HMRC. Whereas years ago, someone would have had to physically go and look. Now they've got a system that goes, oh, this person's got 4 companies, and we can see that they've not calculated their effective rate correctly based on this easy win, right? And whereas in the past, those that don't know, historically, that's not really the people they proactively went after. I think it's fair to say. I think HMRC would have looked at this, I can't speak on their behalf, almost with a commercial view, like, okay, if we're going to go after someone, the amount that we're going to spend to investigate them needs to justify how much money we think we're getting back.
Exactly.
So let's go after the multi-millionaires who we think owe us millions, whereas now it's like, well, this is easy. We can just send a lot of letters and very quickly get people to adjust, where in fairness, they have actually potentially made a mistake. Right? So
what I would say just with that before we move on, but lots of these letters are incorrect as well. So if a company is dormant or a company is exempt from VAT, such as property, but they're sending out so many they're sending too many rather than too little. So there's not a lot of substance to their letter. It's about the reply. Is actually, So lots of people are just paying things because they don't have an accountant and they think, oh my God, HMRC said I owe this. You may not owe that.
Yeah, good point, right? So if I've got a standard propco and I just own 5 buy-to-lets but the turnover's over 90 grand, I might potentially, from what you're saying, get a letter from HMRC, assuming I'm doing my own returns, which I'm not. I strongly recommend getting a qualified tax advisor and an accountant. I might get a letter and go, oh, you need to register for VAT. Incorrectly register for VAT and start paying VAT because you can't. So that's interesting. I wonder if it's a new system. They've not really refined it, or if they're just like spray and pray. If we send out enough of this stuff, we're just going to put the fear into people. I don't remember, you don't know if you're old enough to remember the adverts, but years ago, it used to be like radio adverts. So it's like footsteps. HMRC is coming for you. So anywho, all right, so lots of letters coming out, lots of AI in there, and you hear a lot about this, right? HMRC are using AI to trawl through social media, they're using AI, of course they are. This is the era that we're in. But also don't kid yourself that they weren't looking at your social media years ago. If they're going to investigate you, there's no rule that says we can't look at their Facebook. That's probably one of the first places that they're going to look. How often do these letters have merit then?
We have lots of clients. So lots of them have merit, but everything needs to be looked at. And what they say is if you don't respond, you're guilty, essentially. They say respond by this day or there's penalties. So you have to take action. And this is really new. And we're seeing more and more of these things come out. HMRC have been really, really archaic for decades. Their books are a mess. I'm pretty sure they're insolvent if you actually look at their audit history. But now they've got this mechanism to automate the collection of fines. And rather than taxing you, which they can calculate how much tax should be due, the tax system, we spend more on welfare than we do collect in income tax for the first year ever. So the tax system doesn't work. So naturally they need to, and obviously I don't agree with it, but if they spend more on welfare than they collect in income tax, and they know that categorically, they need to have a mechanism to collect more money. And they're doing that through penalties. And some of these penalties might just be overlooked, and then you don't respond for 2 or 3 years, and all of a sudden you've got a £7,000 bill for something that was £70 initially. That's revenue for HMRC.
These are the speeding tickets of the tax world.
Yeah, exactly.
Makes sense. And so talking about tax and looking at where we're at right now, we've got a budget coming in a few months' time. What are you expecting might happen? Apart from more tax.
Well, yeah, the key thing I would say is avoid the noise. Nobody knows, literally nobody. Even the people who will be giving that speech don't know what they'll say because things will be pulled and changed. There's so much noise. We're going to have rent controls. Well, that yesterday came out and said it's not true. We're going to add national insurance on rental income. Well, that's just speculation. They're going after fear, uncertainty, doubt. They want clicks. They want income through viewership. And by they, I mean the media system. We do the same. So if I'm posting a video, I'll do something that may catch your attention because that is how you market. It's no different there. So I would avoid all of the noise. Nothing, this new government, I think it was the 7th Prime Minister in 10 years, kicked out the old cabinet, essentially. We've got a new Chancellor in. We don't know much about him. We know he started in 1994. He seems to be centre-left, but what does that mean? Different taxes affect different people. Some people have lots of mortgages, some people don't. Some people are onshore, some people are offshore. I wait and see. The budget will come out, the facts will land, we'll look at specifically how this affects our clients and everybody else, and then we'll let everybody know immediately what you should be doing. Lots of people fear changes. They make really large decisions. Previously, I say previously, historically, you go back, there's always been talk of capital gains tax matching income tax. It's not happened yet. It has changed. People were selling massive assets, thinking they'd be paying 45% capital gains tax. And then actually, they just raised it from 10% to 18%. So nothing's changed, but they may have just released an asset that if they had held on to, they may have made an extra 2 or 3 million in equity. I don't like to guess. We work with the facts. We work objectively. We get the information. We give it to our clients and social media and everybody else in the most accurate and speedy way possible. Whatever happens, it doesn't matter. We've got a plan. Property is the best investment class in the UK, that is. We're a tiny island. We have net migration. It's impossible to build on all of the land because there's so much regulation. The planning system is broken. Refurb costs and building costs have gone through the roof. These massive developers have these massive plots of land and they're saying, well, actually, we don't want to build it right now because it doesn't make sense. We'll just wait for house prices to be 40% more in 10 years, which is the key reason we're investing in property. Then they'll build it. If you're investing in long-term cash flowing, appreciating assets in the UK, you just ignore the headlines and you stick to the plan. And you have a plan, which is the key thing. Have a plan.
That's why Warren Buffett, best investor of all time, said always invest for the long term. People get caught up in, as you call it, the noise and forget that the media's job is getting your attention.
Yeah.
And they know that you don't get people's attention by telling them everything's great. They get your attention by telling you everything's about to go wrong, everything, you're in trouble. And if history tells us anything, even just recent, we look at these recent budgets and most of the things that were supposed to happen, according to the media, didn't happen. And I sometimes wonder how much is leaked as a distraction, right? So government say, oh, we're going to do this. Everyone panics about this. And then bam, they go and do that. They're not fools. They play this game, right? Some of it is potentially testing the response, right?
Yes, absolutely.
Because they control the release of that info. Let's release this. Let's see how the people respond. Can we get away with it? I think we can get away with it. Or no, I don't think we can get away with it. Too much backlash. We'll do something else. The capital gains tax was an interesting one because that was so prevalent in one of the recent budgets. And in our deal sourcing company where we sell properties, we had a guy who was in that position where he's pushing our buyers. He's 3 HMOs they're buying from him, collectively about £1.5 million worth of property. And he was, if you guys don't complete before the budget, I'm pulling all the deals. I'm going to, because he was petrified about this. His belief and fear about the capital gains tax drove our buyers insane, bless them. And they did everything. They moved hell and earth to complete on these properties. And then luckily for them, what was announced was a stamp duty change.
Yep.
And so I loved it because I just thought it was so cool that they went through so much and they benefited from the fact that they managed to go in before the additional rate was increased to 5%.
Yeah.
But it was almost the opposite of what people were expecting. It was a tax on the way in rather than the tax on the way out. And it's not to say that capital gains tax isn't going to change.
It probably will happen now. We've said it won't.
It probably will, right? So no smoke without a fire. But at the same time, the point really is don't get caught up in the noise. I think you can't make decisions on a lack of information and you can't make decisions on assumption. What do we know? And that's almost what you grounded us out in. You grounded us out in what do we know? We know that there are more people looking for houses than houses are available. We know that the population is increasing at a faster rate than the level of houses are increasing. We know that the government has said they're going to build 300,000 homes a year and they're 400,000 homes deficient on their budget of how many homes they were going to build. So they're behind. We know that the last time 300,000 were built was in the mid-70s, so 50 years ago, half a century ago. And we know that that target is low anyway. According to the UK Centre for Policy Studies, we would need 500,000 homes a year for 10 years to get anywhere near. That only pushes prices one way. And so if you look at the individual landlords that are like, oh, I don't like renters reform, buy. I don't like this new tax because I'm in the wrong structure, buy. And then meanwhile, you got these institutions, massive institutions, pension funds, you got Blackstone, Aviva, Legal in general, you've got Lloyd's Living pumping billions in the UK property market. What's the smart money doing?
Smart money, that's it. They have the information.
Of course they do. So the media stirs everyone up and the individuals are, oh, no. Meanwhile, these guys are pumping billions. Lloyd's Living have bought 7,000 homes, £2 billion worth, with a goal of buying another 43,000 by the end of 2030. That is a phenomenal amount. Now, I'd like to think those guys have put some level of research into what they're doing, right? So it's interesting to look at how the market shifts. And it's interesting to look at, you could do this in any market, right? Obviously, we're property guys. That's our thing. But if you look at the crypto market, you look at stocks and shares, you look at gold, the markets are so interestingly emotionally driven at all times. And it's like you control people for emotion.
There's no space for emotion in long-term investing. And because we've got a client base, people confide in their accountant. When these things happen, that's one of the biggest pieces of value we give to our clients is we give them assurance that we're investors too. The amount of people who message me around those periods saying, I'm selling. And I'd say, why? Not, oh, here's your bill if you sell. I was like, why are you selling? And they'd speak to me. And then I'd just reaffirm with them that if people sell, there's less properties and there's a very simple economic supply and demand. And if you hang in there long term, the yield goes up. You get more rent. I'm not saying this is good for renters, but I'm saying this is the facts. If you tax the super wealthy and they remove themselves and their workforce, all of these things, it has the opposite effect of what the headlines tell you.
Every time.
Renters reform. Everybody was terrified. For me, that's noise. And yeah, it has come in. And the properties that I am buying, the rents have all of a sudden gone up £100 per month in the space of like 3 or 4 months because people are so scared there's less properties. So it's made the investment class even more strong. all that does is push out people who are not professionals. Slum landlords, there's no space for slum business owners, slum landlords. They never survive. But we are professionals. We're professional investors. And when it gets harder for the market, temporarily, it gets more profitable, essentially, for you. And that's the key thing.
I think people are scared by taxation, regulation, legislation, whereas right now is the best opportunity that I've ever seen out of 19 years of property investment for well-educated, supported investors to capitalize and do incredibly well. And in order to do that, I use each of those words intentionally. Well-educated. I don't mean educated that you've got 17 degrees. I mean well-educated in that you're doing your research on what is the taxation, the legislation and the regulation, and supported that you've got people that are walking that path and can guide you like yourself, people that are professional and expert in different areas along the way. Because renters reform, that was noise, in my opinion. Yeah. That was so much noise. I looked at it and I was like, okay, so we don't have fixed tenancies anymore.
Yeah.
So what? I've had it, I've been a landlord for a very long time. And if someone was in a 12-month tenancy, I've had this multiple times, and they came 4, 5 months, 7 months in and said, look, my circumstances have changed. I'd like to move. Okay, fine. Just give me 1 month's notice and just go. I never held someone to ransom on a fixed contract. Why would I? We can fill a property, let them go. So that's fine by me. 2 months notice, even more than the 1 month we used to ask for. We didn't really take 6 months payments up front from people, because my question was always like, if you can't demonstrate that you can pay it now, what changes in 6 months time? So that was never a thing that we did. I've never evicted a tenant in my life on a Section 21. So why do I care? If someone's made a home out of something, great, stay there, crack on. That's the entire purpose of this, that's providing homes. So I just didn't see personally any real issue, but the media got in there and whipped the people up, and people read headlines.
Yeah.
People read headlines and they don't actually get into the nuts and bolts of what's really going on. Actually, it's necessary to provide a level of support and cover and protection to tenants. It's their home. It's their house. That's a serious thing, right? You can't just kick people out because you've changed your mind and you want to do God knows what with your property. I think that's all perfectly reasonable. So that's neither here nor there. Then you've got the taxation changes. But if you are actually doing as you say, and you're following the guidance and the advice of people that know what they're doing, you can still be, and correct me if I'm wrong, more tax efficient as a landlord that's well structured than the average individual in a PAYE job. Would that be a fair statement?
Non-comparable.
Yeah, non-comparable, right? So again, but is that the headline? No. The headline is landlords getting obliterated.
But we like that because, again, it benefits the professional.
The logical.
I wouldn't change a single thing. And these things don't happen overnight. So the student market was affected. But all of the large landlords that I know who had student accommodation, they had ample time to pivot, and now they're with professionals. We know what's happening, and we have time to adapt if you need to adapt. And that's the thing with property. It works for everybody. You can have buy-to-lets, HMO, service accommodation, commercial units, conversions. You don't have to own the asset. You can control the asset. You can do rent. There's so many different types. It all works, but it all works completely differently. Some you need more time, some you need more capital, some you need more experience. And as long as you have a plan and you work backwards from the goal. So when I purchase a property, all I care about is I will die with the property. Simple, don't sell it. It's paying cash flow from day one, a good cash flow. You can choose the cash flow. There's no guessing there. And I buy freehold. I buy freehold houses because I think they go up more in the long term, and you don't have all of the nuances that come with ground rent and leaseholds and flats and things like that. That's my strategy. That works for me. That may not work for somebody in a different circumstance, but I've deliberately chosen that. Somebody may have the goal of replacing their income with £80,000 in 4 years. Well, maybe you need a higher cash flowing model. You don't have as much time as I have. Service accommodation. Go and buy 2 units in a very high demand area, and you'll replace your income pretty quickly, but you need more time, maybe expertise, but you can leverage other people's expertise. It all works. So when these changes do come in, such as the renters reform, as long as you've had a plan and you've not had, some people have little pockets of everything and it's not very effective. Look at what you're doing. Okay, this is going to change. Will it affect me? What's the worst case? Look at the worst case. If that's fine, carry on as normal. Say I had 10 HMOs and it's in the student market and all of a sudden the students can hand in their, after the final exam, they hand in their notice. Okay, well, I need to make a change. You're a business owner. Go and do it. You have to make a change. Simple. Once that change is made, carry on as normal. The people who panic sell, and this is why I like property, because you can't emotionally release it. Takes a while, takes a few months. Usually you calm down. Stocks and shares, crypto, things like that for me. And investing in general is linked to your personality. So I know what kind of person I am. I like property because I can't make any panic decisions with it. I've sold portfolios of random coins in the past and I wish I'd held on to them. That's not really investing, that's gambling, because I didn't know what I was doing. Property, you can have every piece of information and it's almost guaranteed as long as you're patient with it and you give yourself enough time for it to work. There's no gambling here. So things will always change, but you can always use it to your benefit.
Love that. And it's interesting to loosely compare property to other asset classes. I think naturally, again, heavily biased. I'm a property person. I've bought shares in the past. I still got some shares now, parked up in a nicer, but usual stuff. Bought gold. Bought crypto, very volatile, very almost more speculative, I guess.
Yeah.
Again, before I get the crypto bros ripping me to shreds online, I'm not saying anything wrong with your Bitcoin. All right, Bitcoin. I was involved in Bitcoin from 2015 or prior, so a very long time. At the same time, if I go into the bank with 50 grand, they're probably not going to lend me 150 grand to buy more Bitcoin. If I go into 50 grand, they'll lend me 150 grand to buy a property. So now I've got leverage. I can buy 4 times the value of what my cash is. Equally, I've got something that's always going to serve a definite purpose. Somebody needs a home to live in. We know there's a scarce resource. It's a physical asset. I've never had a house nicked. I've never had someone hack my house and it disappears.
Yeah.
So I think there's, for me, so much value. There's cash flow as well as capital growth, and it's proven. So that's a really quick nutshell of why I think property is a brilliant choice. Now, to elaborate on your strategy, because you touched on, and I love the fact you highlighted that point, that there's so many different strategies. What are your goals? What are your resources? One thing that's right for you might not be right for someone else. There's probably people that are just curious, stroke nosy, that want to know what is that strategy that you do. As I understand it, you're buy, refurbish, refinance. So buy something, add value to it, pull money back out as much as possible, and buy to let, because that allows you to then keep majority of your time to focus on your trade and business. So you're building wealth that you will die with, to your words. I'm just wanted to quote what you said. So you're building wealth, you're funding that presumably from your trade and business, which is great. Maybe we'll touch on that in a second. And you also use deal sources, from what I understand, which is interesting.
Yeah.
And so what's the rationale? Because there's people here that will be, in fact, for the people that don't know, what's a deal sourcer? Why would you use a deal sourcer to buy a property rather than just go and find them yourself?
When I first decided to invest in property, I was driving up and down the UK. I'm not a builder. I don't want to manage build teams. If you're buying property with a mortgage initially and there's no refurb needed, you're competing with absolutely everybody. You're competing with that new married couple who want to buy their forever home and they're not thinking, well, they would pay whatever they want because they like the house. We don't want to compete with those people. We want to buy properties where you have a competitive edge. And by buying the worst, smelliest, most broken home on the street that's been on the market, it's been broken into. Some of the houses I've bought this year didn't have front doors.
You're describing my personal
But this is where the money is made. So with property, you make money on the entry. When I first started, I thought, why would I pay somebody money to go and find me a house? They're on Rightmove. The first property I purchased was in Leeds. I left 50k in that property. I learned so much from that property. Great property. It's gone up in value. Pays me, I think, $1,100 a month. It's got a small mortgage on it. But looking at the capital I left in that now, I could have bought 3 or 4 of the properties that I'm actually buying. You have to accept the fact that you need to start. The first thing you do with anything is not going to be perfect. You're paying your dues, quite literally. You can make it as less messy as possible by utilizing professionals and people around you. But most people don't get started. They speak to their family, their friends, whoever, and they say, why would you do that? Oh my God, look at this. You have to get started. So the first property I didn't use somebody. And even that's got an EPC of E. That might be the only property I may have to let go because it's a 4-story building. It's got a old basement. I just wouldn't go near that again. But I've learned so much from it. Now I know what not to do. Every property I purchase is cash, which means you're not competing with people with a mortgage because the person selling the property wants a quick sale. We're serious. We're not in a chain. We're investors. Most people, when you purchase a property, you need to sell a property. It can be really long. We purchase these properties in 6 weeks. So when you go to somebody who's got a property on the market and it's so run down and it's unlivable, and we say, we'll take this off your hands. You can hand over the keys in 6 weeks. We'll skip it. We'll indemnify things. We won't bother doing searches. We just get the property. You've made money from day one. You get it 10, 15, 20 grand cheaper. It's not magic. It's you've got cash. You've had to work hard for the cash and you're serious. Okay. So that's the first thing. Then the second level of adding value to the property, which is where it becomes really tax efficient. And if you're building a portfolio, you need to know if you're selling or holding on to the property because things are taxed differently. I don't sell properties. When you invest via a company, you have a capital expenditure or a revenue. And revenue is where you want your costs to be in its repairs and maintenance. You're bringing the property back to life. You're not adding extensions. You're not adding marble floors and decoration, things that weren't there. Because if you're flipping a property and selling it on, you get tax relief. But if you're holding on to that property long term, there's no tax relief. But if you have to do damp work in the property, if you have to replace the boiler that was already there, if you have to replace the electrics, if you have to paint it, basically making it the perfect new build in an old building, but you've not drastically increased the value of it, but it doesn't matter because we've purchased it at a discount anyway, and you've made it really shiny and new. So when the bank go there to value it, you may have added 20, 30, 40 grand. And even if you don't, you can refinance it on a second or fifth year when your mortgage is up. You want to recycle your cash. So you buy in cash, you're quick, you get a discount, you refurb it. If you're holding on to it, you just want to repair and replace things, put a tenant in there. It's got no mortgage initially, makes £500, £600, £700 profit per month. Your repairs and maintenance are minimal because you've just repaired the whole property. The tenant who goes in, zero bad credit. There's no negotiation. That is the most important part of finding a tenant, making sure they're the perfect person. I don't care about animals. People with animals tend to stay longer because they've got an animal. And then you can send the bank there, refinance it at the new value. You will comfortably get a 75% buy-to-let mortgage. So if you purchased a property for 50, you've spent 25 on it, you're into it for 80k, it's now worth 100. Well, the bank will give you a 75% mortgage. You'll get back 75k, give or take some legal fees. You've left £5,000 to £6,000 in that property. Amazing.
And the return is
infinite.
So to recap a couple of key points I want to pull out and just share. It's interesting. I was sitting there thinking, this is one of those podcasts. Sometimes you listen to podcasts, you put on 1.2, 1.5, maybe even 2 times speed. This one, I think people are going to have it like 0.8, 0.8, 0.5, writing notes. What did he say? So number one, you make money when you buy. I'm going to just emphasize that. So it's easier to get 20 grand off an asking price than to add 20 grand for a refurb, right? So we want to buy at the right price. Number two, a strong buyer. If you're an investor, you're not in a chain. I've seen it many times. Seller will accept less because they got more certainty that that person's actually going to complete on the purchase. Next up, you mentioned so much, man. There's so much gold here. Your overarching strategy, and buy, refurbish, refinance. I wanted to move into let's go there. Actually, one last point. You mentioned about, I don't care if they've got an animal. And this is another thing out in the renters reform. People are like, but now they can have a dog. I couldn't care less. I've never declined. Yeah, what's wrong with dogs? 1/3 of the population has dogs. So good way to exclude your whole market. Same in short-term lets. I'm like, bring your dog. We'll just clean it afterwards. That's what the cleaners do. So interesting, again, perception versus reality for people. But I personally have, I don't have many buy-to-lets left. I've got some historic ones, but they tend to have dogs in them. Once I went to one, this is complete tangent. I remember going to a buy-to-let. It's time for a tangent. We've not had one yet. I remember going to do an inspection on this property, right? The people had never asked me to have a pet. It was a couple in their house, 3-bedroom cottage, nice house. But I equally would have had no issue with it. But I've gone to the property and they were in the front rooms. I've gone into the front room with them, looking around different rooms. I've started talking to them. They looked uncomfortable. I'm like, why do they look uncomfortable? Like, is there an issue? I thought we had a good relationship. And you can see them sort of semi looking at each other. And as we're sat there, I just heard from behind the sofa. And basically they had a dog crate that they'd covered up. They put the dog in and hoping the dog would be quiet. I just didn't say anything. I just don't care. You know, if they'd asked me, and it's a shame because they didn't feel comfortable to ask, because probably they're expecting that somebody would say no. Had they asked me, I would have just said it was fine anyway. Anyway, that's my tangent on pets. More going back high level and strategic then. The structure that I have and the structure that you have, I believe from many of our conversations is very similar, or our approach to business and investment is very similar. I want to lay it out super simply for people so that they understand what that is. Not to say that's the only way or the best way. It's just a way that we both find works very well, which is to have businesses and to have investments, and to specifically use the businesses to fund the investments. And I mean, this is very Robert Kiyosaki, but it's also a very straightforward approach that for me works very well. So for me personally, I've got a deal sourcing business. I've got a lettings agency. I've got a finance brokerage. We've got multiple businesses in the property space that generate income for us. Rather than just spend that income, because business is not guaranteed. Statistically, there's a strong likelihood those businesses might not be here in 10 years' time. So rather than just spend that income, our approach is put that money into buying assets that will exist forever and will provide infinite return, and use the money from those properties to live.
Yeah.
Right. So rather than spend this, and this is for anyone there that's got a trading business that's making money, or that's thinking, how do I approach this? Maybe a business in property that generates good income, like deal sourcing, lettings, finance broking, whatever. Obviously don't tread on my turf, because I'd hate to see us in court together. Just kidding. Do your thing. There's plenty of properties out there. People go, if I get this a lot. Why do you tell people what to do? Aren't you worried that people, I'm like, do you know how many properties there are out there? There's millions. I don't think we're at risk yet of everyone becoming stark competition. So I believe your approach to business is similar. Is that and
identical? So just quickly going back to the deal sourcing, why I use a deal sourcer, because it saves me so much money by paying somebody a fee who knows an area to manage a build team while I make money in my trading business. Mm-hmm. You will never get a better return on your time into anything than a trading business. Its scalability is unlimited, depending what your business is, of course, but you can always start another business. Typically we learn, and then we're like, okay, we could do this as well, and we could take this system. But you make money in a business. This is the ideal way. Some people have very well-paid jobs. Some people have lots of cash through random events, and they want to park it. But typically, you make money in a business. You're as tax efficient as possible. You have excess cash. You invest your fast money over here into slow money over here. That's key. So your investments are guaranteed to pay your rental. On average, will pay you every single month for the next 100 years. But your trading business may not be here in 5 years. But you can make 10 times the amount of money in a trading business than investments. But property serves every purpose too, because as long as you understand some of those strategies are actually trading businesses, even in the way they're taxed. So rent-to-rent models, some people may have 15 rent-to-rents. That's a trading business. That is, you need systems, staff, management. That's a business. Mm-hmm. But then lots of people might take that cash and then put it into the same business, but they own the asset and they just hand that to a letting agent and they think that'll be there in 20 years. That property over here that's guaranteed to pay me, that is not linked to my time, energy, or risk threshold, because the trading business is usually where the risk lies, allows me to hand back 2 of these rent-to-rent HMOs And now I'm getting paid the same money, but I've got a little bit more time back. And we all want to control our time. Some people, you and I are identical like this. If we have additional time, we fill it. We're reading books, we're doing something, we're doing podcasts. That's who we are.
Optimizers.
Yeah, we're in the gym. Like, it's something, we're never satiated. It's the entrepreneur's curse. That's all we know. Some people want a guaranteed $5,000 a month for the rest of their life so they can sit in the garden and read novels. There's no right or wrong answer. I'm not going to go down a happiness tangent, but there's no right or wrong answer.
Episode.
Yeah, but that's what the long-term investment does. But the trading business can be property too. Deal sourcing, you've got to go out there and find the properties. You're selling a product or a service, both in that sense, because technically but they're trading businesses. You're going to pay VAT. You might need 2 or 3 people on the ground to facilitate the business. But as long as you're taking that capital once you make it and putting it into guaranteed, and I don't like the word guaranteed with lots of things, but UK property, if you own it and you're being realistic with it, is a guaranteed asset that will go up in time. You can look at the last 1,000 years and it's safe and you can forget about it. Make money, park it, make money, park it, reevaluate your business plan every 3 to 5 years, make sure you're still heading in the direction you need to be or want to be. But the property side of it stays there forever.
I love it. And I think as investors, we're naturally fixated on ROI, right? If I put my money into this, what's my return that I get? And people forget ROTI, which you reference, which is return on time invested.
Yeah.
So if you are to go and this is a classic error that I see, it's I'm not going to pay X amount, insert amount here, 5,000, 10,000, whatever it is, to a deal sourcer because that's a lot of money. I would rather go and find the property myself. Fine, but it's the opportunity cost of what you're now not doing with your time. So in your case, if you pull yourself away from your trading business, you will lose more. Absolutely. Under that false economy of I'm going to save on this fee.
Yep.
And this was actually a big identity shift for me, realizing where historically I've always been very careful with my spending. However, and if I can do it, I would do it. I can fix that sink, right? I can paint that wall. I can do that. And now over the last few years, I've had to really shift my thinking to that is not a good use of my time. And because it's not, I save £500 by doing this thing and I make £1,000 immediately by doing that thing. It is, I save 500 by doing this thing, or I possibly, if all goes well, will ultimately add more value here.
Yeah.
But it's harder to see. It's not directly quantifiable sometimes in business, but that to grow, scale, manage your existing business is generally more valuable. And you hit on some good points. It's not like a job. If you're in a career, you kind of get capped on how far you can go, right? If you're in a business, you're in the right industry, the right business, and you're doing it in the right way, you just keep putting zeros on the end as much as you want to.
Mm-hmm.
And there's no right or wrong. $5,000 a month, $500,000 a month. That's just a matter of personal preference and what you're willing to sacrifice or trade off, because it is a game of trade-offs as well. But the short point there is I do think that as investors, we have to look at how we invest our time and what's the return on my time. And so I had a big identity shift years ago from being a landlord, which I would say is going and doing viewings, writing out tenancy agreements, fixing the sink, doing the odd bits and pieces around the property, to being an investor, which is saying I will pay someone to manage the property, I will pay someone to do that, and accepting that although in the short term that makes this less profitable, in the long term my time is better spent here on this thing that has much more potential to be much more profitable. And I still reevaluate this to this day, because again, is my time well spent trying to save X here, or is it best spent trying to make Y over there? Usually the latter.
Yeah.
But it's a constant, you're almost going back to emotion logic. I'm always fight the emotion of, I don't want to overpay on this thing for this thing I could do myself in half a day, and I now have to pay someone 2 days worth of money. Get over it. I think the price, the return on time invested, to summarize it in the simplest way, really when you're in business, what you're ultimately trying to do, or in investment, is get your time back. And your time is always best spent looking at how you will achieve more revenue. If I simplify it in its purest sense, and for all the while that you're trying to maximize profit by minimizing expense, and this is for people that really want to grow. Obviously, you can get to a point where the $5,000 a month, maybe you do just want to optimize that, and that's fine. But if you're looking to continue progressing infinitely, which I believe you and I probably will, irrespective of where we go, I don't think for me there's a clear goal. I don't know if for you there is a clear financial target.
I wish.
I'm of the Napoleon Hill school of thought, which is that success is the progressive realization of a worthy ideal. And so I just want to keep on growing, delivering impact, and seeing things have the resources and capabilities of thriving. So our job, if you hire a member of staff, is to give you time back. That's, people think you hire a member of staff to carry out a job. I hire a member of staff to give me time back to look at how do I grow and develop this business, this investment. I hire another person or a firm or an agency to give me time back to help me to grow. And I think we're of a similar, or you just touched on it. So you would pay a deal sourcer. How much do you pay roughly?
$5,000.
$5,000, right? So some people go, oh, $5,000.
Yeah.
I can, like you said, I can find a deal on Rightmove. What's the trade-off? Well, you might get that deal in Leeds, because either you pay for the service or you pay an undefined amount for the lesson. You pay for the lesson one way or another, right? You pay for the learning one way or another.
You need, the thing we see with property investors, you have to have a sense of urgency. I've purchased 5 properties this year, and it's taken 7 properties because 2 fell through. So if you have cash, and using deal sources as well, it depends on how many properties you want, because if you want to buy 2 or 3 at the same time, you have to use other people. Mm-hmm. So please do, and protect your time and make money. But with property, you have to have a sense of urgency, at least initially. So if you want to buy 10 properties, but you say you're going to buy 1 a year and I'll put in 1 offer a year, you probably need to put in 20 offers to buy 10 properties. There will be issues. There will be problems with surveys. They might fall out. I had somebody pass away on the day of completion that had already been in legals for 3 months. So if you're planning on buying 5 properties, you need to put in so much energy and effort to actually make that happen. And people are unaware of that. They think, oh, you can buy 10 properties in a month. You cannot. It takes years.
It's a lot. I think you've correctly managed certain expectations as well. I had a deal fall through this week, right? I had a deal fall through last month, and that's part and parcel of this game. Sometimes when people have their first deal ever fall through, it feels like their world's falling apart and the whole dream shattered. It's unfortunately just a part of business. And so I say that for the people who may have a deal fall through, just keep going. Yeah. On the scale of probability, if you keep going, you will land your deals. For every deal that's fallen through, there's probably been 5 that have gone through, to your point as well. And I think that it's a case of, when you get a knockback, getting back in the game. But what you're effectively saying then is to approach it with a level of enthusiasm, to make it a priority because otherwise it's not something you can just passively do.
It's so easy to put to the bottom of your to-do list, because finding a property and even mentally making a decision to purchase it, what you said about the price. I purchased 2 properties pretty much next door to each other, and I paid £8,000 more for one of them. Which one did I overpay on? It doesn't matter. Which one did I underpay? Was one a bargain? You could easily sit down and think, oh, I can't buy that because I've just purchased that one. But that's refurbed, that's rented, that's making me an income. That money will be recycled to go into the next property. We have clients who have been with us for 3 or 4 years, and they've never pulled the trigger. And I say to them, just buy the first one and the other 9 will come.
What do you think holds people back?
People, family, friends. You should not be listening to anybody if they've not done the thing. And that is with just in life. Mm-hmm. If they have not done the specific thing that you are wanting to do, why would you listen to them? They have no idea what they're talking about. I am not a dentist. I cannot talk to you about anything a dentist does. And if somebody asked me, I'd probably give them my opinion. Should they listen to me? Absolutely no. But we have ego. We're going to answer questions. I am a property investor. I own an accountancy firm. I'm a tax specialist. Ask me about property and tax all day long and I'll give you perfect information. But if you ask me about something else, you ask me about the trees, I would give you my opinion. That opinion is worth nothing. So when you're looking for a way out, such as I'm scared to make this initial investment, it's very easy to say, hi, Mum, what do you think I should do? Oh, that's risky. You've been working so hard for that money. What if this happens? Oh, okay, I won't buy it. And then you never invest and you never get started. It's those sorts of conversations. And these people around you, they're not doing anything malicious. They're just telling you what they would do. Yeah.
And I think people make decisions with emotion and justify them with logic, right? And so it's easier to follow fear.
Yeah.
And so if people are talking you out of something, then and I've been there. I've been talked out of deals in the past when my circles were different. And I look back on those deals, I'm like, I can't believe I didn't go through with that deal. It would have been phenomenal. It made sense to me logically, but the people that I was around, they didn't understand what I was doing. They didn't understand how it worked. So they were adamant that, no, you're going to go bankrupt. You shouldn't get this many mortgages. Debt is bad, blah, blah, blah. And so I've lived that. I think there's a couple of things. One, you can find a way. Two, you can take advice from the people that are actually doing the thing. Like you say, if I want dental advice, go to a dentist, right? Go to the person that's qualified and practicing. The other thing is, okay, so there's people that know logically it's a good idea. Emotionally, they want to do it. And then maybe they get in their own way, either fear or procrastination, I think. And those guys, going back to what we said at the beginning, so not making it a priority, I often think about this quadrant of urgent, important, non-urgent. I don't know if you're familiar, originally from 7 Habits of Highly Effective People, where you categorize things into these quadrants. So you've got like non-urgent, non-important. That's pointless stuff, right? You've got urgent, important. That tends to be the stuff that is relevant to what you're doing right now and keeps you where you are right now. It's got to be done, and it's quite important because that's your life right now. You've got non-important, urgent. Let's just call it nonsense. Keep it nice and simple. And then you've got non-urgent, important. That is where 90% of the life-changing actions hang out. So I try let me reframe it. Being proactive rather than reactive. When you're dealing with urgent things, you're reactive. When you're being proactive, you're setting an intention saying, this is what I'm going to do. And I think that to be logical, to be an investor, to progress in business, life, in whatever it is, you have to at some point prioritize important, non-urgent things, because they are the things that take your life forward. Important, non-urgent, I'm going to go and find myself a deal source. If I don't do it, I don't die. Nothing in my day-to-day life changes. So it's easy to kick it to the back of my to-do list. There's no pressure. That's the exact thing that should be at the front of my to-do list, to arrange finance, to take the steps, to get the education, to do whatever it is that's going to progress you in any area is usually important, non-urgent. That is, and if people take that away, I just want them to think about the things on your to-do list. And if you listen to this, you probably got a to-do list and maybe you got too many things on it. And ask yourself, what is the one thing on that list that is important, not urgent, and if I just focused on that, will take my life to the next level? I guess that's something that I question myself on a lot, because we naturally gravitate to these things that are urgent. I'm like, no, leave me alone. First 4 hours of the day, I'm focusing on important, non-urgent tasks, and then we can get into the reactive stuff. Not sure how we got to that part.
That book was the first effective book I read that changed a lot of things for me, especially Sharpen the Saw, number 7, which is the thing we spoke about this outside, the thinking time where we're not doing, we're just thinking, and you can't have any goal. You just sit down and you think, and it gives you space to actually evaluate what's been going on recently, because we're always pulled. You have emails, your phone, constant distraction, Instagram, TikTok. Oh, I need to post this. Oh, this person's angry. You need that time to sharpen your saw so you're not just swinging a blunt axe. And it's exactly what you speak about there, where it's so easy to not do.
That sharpening saw, and actually that thinking time, to elaborate on that, as busy entrepreneurs and with personal lives and professional lives, there's so much noise, especially in this era, and people will hear me say this again and again and again, and eventually they'll hear it. The person in this day and age, I deeply believe, that has the ability to focus in its purest sense and to minimize distraction will be the person that wins. We live in an era where everything is designed to capture your attention and hold it, generally for no value to you whatsoever. Social media, phones, the noise, the dopamine hits, the social dynamics of it all. The more, and I know we're similar on this and we've had our own conversations around this, but the more you can do that, I always reference John Whittemore, Coaching for Performance, who said that performance is equivalent to your potential minus interference. So how well you can do in anything is as good as your potential, which is unlimited, minus interference, which is all of the pointless distractions that pull you away from that potential on a day-to-day basis. You cannot overstate the importance of space. The music is what happens in between the notes, stepping away from things. If you look at some of the most intelligent and successful people over time, then you can see that pattern for all of them have their own. Bill Gates has Think Week, where he goes to a log cabin in the middle of nowhere with a bunch of books, right? There's different people have their own way about doing this. I am quite known for taking myself to a spa, leaving my phone in the room and spending a couple of days with pen and paper. That is where the magic happens. It doesn't happen here when I'm in the midst of the business and I'm responding and reacting. It happens when I step back and I can see things from that different perspective and go, hold on, this can change. This could be better. I can do something different here. This ship's not even going in the right direction. I need to adjust course a little bit. That is... Well, what would your advice be? So someone listening, they're like, okay, strategically that makes sense. Practically, what does that look like? What would your advice be to someone in terms of getting that space to think, and what does that actually look like? What's the goal?
You have to be brave. So with property, and we can only really say this about property because there's so much data behind it, we're not gambling. And if you look at the net wealth of most successful people, regardless of how they've made their money, and this is everywhere in the world, what do they do with their cash? Well, a massive chunk of that is in real estate. In the UK, we're in a very special market because of the things we spoke about previously, where we're a tiny island. There's such good economic value here. People want to be here. There's demand. That's never going to change. So we're not gambling. So the advice is, once you make it, and you have to work backwards from your plan, but you also need to make it bite-sized. So rather than saying, I want 10 properties, well, you need to buy the first one and just accept the fact that it may not be the best purchase.
It won't.
It possibly, if you listen to like somebody, you and I have done it. I wouldn't have listened to us because I would have just done what I was doing. You have to walk it yourself. But with this road, you know that you're not going to go too far off. You're not going to lose money. Essentially, what you're doing is you're taking cash, moving it into a physical, tangible asset with inherent value. And worst case scenario, you sell it and get most of your money back. Or you wait 5 years and make some money and then pay some tax. It's very little risk. But it's an emotional barrier. Most people spend £10 on lunch and all of a sudden they need to spend £80,000 on a property purchase. It's an emotional barrier. So you need to get the first one out of the way. Debt is a very interesting word because we are conditioned to think debt is bad. You have good debt and you have bad debt. And if you're using somebody else's money, the banks and institutions' money, that is going to give that to you to buy an asset that pays you, well, you need to get over your fear of the word debt as well. Personal guarantee. So when you take out a buy-to-let mortgage, you have a company. The companies have got limited liability, but nobody really tells you, and I remember this, and our clients say it to me all the time, but I remember the first time they said, sign a personal guarantee. And I said, oh, you've made a mistake. I'm purchasing in a company. And they said, oh, that doesn't matter. It's not risky anymore because 20 years ago, you could get a 110% mortgage. You need to have a 25% deposit now. You're safe. It's okay. So all of these things are emotional barriers. And once you push past them, you just repeat the process. When I first started my portfolio, I did that one property. It took forever because I was trying to do everything myself. And I was learning the whole way. I was like, oh, I need to do this now. Oh, I need to do this. Oh, I need independent legal advice. Oh, my broker's rubbish. I need a new broker. Once you've done that first one, you have the system. Mm-hmm. And the second one, not only do you make a lot more money because you're quicker but you know exactly what to buy or not, what not to buy.
Mm-hmm.
My portfolio is in lots of different areas because I was trialing lots of different deal sources and build teams. But then you settle somewhere and it becomes quick. And wealth is built in the speed at which you can move your money and recycle your money. And you have to have a sense of urgency and you have to be quick. And with that, you need confidence. And that only comes from getting over the emotional barrier of that initial property purchase. We're not buying a single speculative stock. We're buying physical assets that if you walk past it in 50 years, it will still be there.
Yeah, I love that. And so many points that I could pull from this. One thing I want to reiterate and pull out quickly is personal guarantees, because that's one I get a lot of, right? At social media, faceless accounts, you know who you are, will jump onto a post and be like, yeah, but if you buy with a limited company, you've got to sign a personal guarantee. Spoiler alert, if you buy in your personal name, you don't have to sign a personal guarantee because you've already personally guaranteed it. It's in your name. So to your point about risk, which it is important, just to be clear, we're not being flippant and saying there's no risk. What we're saying is the risk is minimal. With a personal guarantee, and I'm just highlighting this because it comes up a lot.
Mm-hmm.
If I buy a property for 200,000 and I've got a mortgage of 150,000 in a limited company, and they ask me to sign a personal guarantee for that 150,000 that I'm borrowing, in order for them to ever pursue me personally, a combination of things would have to happen. Number one, I stop paying the mortgage, which will be paid by whoever's occupying the property, or God forbid, if something went wrong, I'd have to pay some of it myself. I stop paying the mortgage for the extent of time that they now are moving to repossess the property from me. This is already an unlikely scenario if I've assessed my demand, if I've got a decent interest coverage ratio, if I've invested sensibly and with the right support. But let's go down that road. So that would have to happen first. The second thing that would have to happen is they repossess the property, sell the property in the absence of me selling it before it gets repossessed for more. And that 200 grand property that's been valued by a Rich Chartered surveyor at 200 grand, that's why they loaned me 150,000, would now have to be sold for less than 150,000 that I owe the bank in order for them to pursue me. And they're not going to pursue me for 150,000. If it's sold for 145, they're going to pursue me personally for £5,000. There is virtually no reason whatsoever to be scared, or just to put this really simply, to be scared or intimidated by a personal guarantee on a property purchase.
Not in that scenario.
Yeah.
Very different.
Finish this at comma. On a property purchase that is backed by a 75% loan to value mortgage. It doesn't bear sense, but people are petrified of it. People won't move. There's people that I know that do not buy because they listen to comments on social media. Mm-hmm. Oh, but you'd have to sign a personal guarantee. They go and get advice from people not doing it. I sign personal guarantees every single week without fail, multiple some weeks, because it's incredibly slim odds. And if those things were to happen, then furthermore, I personally wouldn't want to borrow the money if I didn't have every plan of paying it back anyway, right? So I just want to highlight that. It's a sticking point for a lot of people because they think, oh, now my whole home, my family, everything's at risk. Incredibly unlikely. You'd have to not pay the mortgage, get repossessed, be sold for less, and it's still not going to be. They don't just take your house for 200 grand and then bill you for 150 as well. You know, it's not like it's just not how it works. So to that point, right, I'm conscious of time. I don't know how long we've been talking. I imagine it's been a long time. We generally meet up and talk for 5 or 6 hours before we roll into that. I'd like to do a separate episode one day where we talk about life, because you and I talk about life a lot. I know you like to gravitate conversations towards tax. Yes, you're the tax expert. I actually think you're a very wise person in the way that you approach life as well. But that's another episode for another day. I'd like to go into some quick fires.
Sure.
And that's how we're going to conclude, because what I'm conscious of, I want to just, now my goal is quickly extract as much value as I possibly can for those that were patient enough to go through the entire episode, that took all of the information, that are ready to implement, but just want a few little bonuses, right? Quick fire round. And I don't have a list in mind. I'm going to make the list up as I go of things. Most common question that you get as an accountant:
how do I fund the property purchase?
Cool. We've covered that. What's a relief that most people miss?
Buying probate property, there's no stamp duty if you tick the boxes.
Cool. All right. Nice. I like that. What about, how can I potentially save on VAT on a refurb?
VAT, if you're changing a dwelling from no dwelling to a dwelling, or a single dwelling to a double dwelling, or it's been empty for 2 years, you can not register for VAT, but the builders, and if they're buying the material too, you get a saving, can charge you 5% VAT rather than 20%, which can come to many thousands.
Capital allowances on a commercial property. In a couple of sentences, what are they?
Capital allowances are not available on residential, but they are on commercial. They can be claimed once. And just as a quick example, if a property is worth 400 grand and you put in 100 grand, your capital allowance claim can be 30-40% of the overall cost. So you can potentially claim £120,000 in a capital allowance. It's on the fabric of the building, the aircon, the alarm systems, stairwells. It can only be claimed once. It can't be claimed by pension. So if you're purchasing a commercial property from a pension, have a look at it. You need to have a capital allowance survey. It is a super tax efficient way of having a massive tax saving with commercial property, not residential.
Follow-up question. If I buy a commercial property, you mentioned, and just to reiterate, you can only claim capital allowances on a building once. If I buy it from someone, now majority of the population have never claimed it, never heard what it is. If you do buy it from someone who's already claimed, or you buy it in a way that you can't claim it, capital allowances, make or break, or cherry on top?
Cherry on top. Never purchase a property based on capital allowances. If it's there, great. If it's not, your numbers should stack anyway.
What can I justifiably get as a legitimate expense from my business that some people might forget to put through?
Food, travel, accommodation, as long as these are wholly and exclusively for the business, absolutely. Mileage, if you have a personal vehicle, you are almost certainly doing business mileage. It's 55 pence per mile. You have to manually add that to your accounts. Your accountant will have to do that for you. Anything you've paid for the business, but you've used your personal card is not lost. Let your accountant know, they can add it.
Perfect. And benefit in kind, what could I try and put through the business and get tripped up on that some people might do?
Gym memberships. Most gym memberships, it's just not worth it. Some gym memberships, if you apportion it, such as David Lloyd, and they have office spaces that are primarily for the working part, but HMRC, you can't tell HMRC that the sauna and the ice plunge is for business purposes, so you have to apportion it or pay the benefit in kind.
If I'm buying a property, what taxes would I need to consider?
It depends on your structure. So if you're buying it in your own name, which you shouldn't be, capital gains tax, stamp duty. If you're purchasing in a limited company, you need to be aware there's a 5% surcharge. So that's a punitive entry cost. So typically if you're doing buy-to-lets, that's why we do cheaper buy-to-lets. Commercial property has better stamp duty rates. So there's pros and cons to all of this. You have to understand all of these different taxes before you actually look at the purchase price on Rightmove, because there's additional costs.
How important is mindset in property?
Mindset is everything in property and business and life, just as much as the environment. You absorb absolutely everything. I can't remember who said it, but you're the average of the 5 people. But times have changed where we're digital now, so you don't physically need to be spending time with people. That's a luxury, but the information you're absorbing, podcasts, books, YouTube. What are you doing in your spare time where you're not really conscious? Are you listening to a podcast? Or are you listening to music? If you're driving somewhere for 1 hour, could you be absorbing a podcast like this? You only need 1 or 2 pieces of key information to change your life.
How important is education for somebody who wants to invest in property?
It is the most important thing, but I do think that traditional education is borderline redundant now. I went to university. I thought I'd get a great job. I left. Books changed my life, but not the books I was studying. It was learning from biographies, autobiographies, entrepreneurship, business. Somebody will go through 60 years of turmoil and go through ups and downs, and they'll be depressive and elated, and they'll have all of these lessons, and they will sit down in a room and pour their heart and soul and their thoughts onto a piece of paper that costs you £15 from Waterstones. Yeah, start reading books. You don't have to read them, you can listen to them, but that is what is going to set you apart. And we're naturally a product of our environment, our family, our friends, the school we went to, the social groups we had. You need to leave those. You can go back to them, but you need to put yourself in uncomfortable situations by going up to people and saying, "Hi, how are you? What do you do? Do we have anything in common?" Because it takes 2 or 3 people to change the trajectory of what you're doing. You might have money and have no idea about property, and you speak to somebody and they say, "Oh, you were thinking about doing that. Why don't you do this? This is what I do." Changed your life.
How important then is community and contacts?
Community and contact. So typically, I'm a very, I don't like people, but I speak to very few
Careful what you
people.
say,
Yeah. Community is everything. It doesn't need to be, they need to be doing what you're doing. I'm very linear. I know exactly what my goal is. I know exactly what kind of person I am now. I spend time with the people who are doing things I want to do, are genuine, lovely people who we have a mutually beneficial, symbiotic relationship. But you need that. You cannot do anything in a good way if you're isolated, but be careful about being around people who don't serve you and just want to take.
So networking with intention. Okay, cool. And last question. No, not last question. Penultimate question. 3 books that you would recommend to somebody listening.
On philosophy, Marcus Aurelius Meditations, one of the best. If you're just getting started, I'd say a very cliche book, Rich Dad, Poor Dad by Richard. He is a very repetitive book, but when you first learn that, it just makes everything crystal clear. And here's a new one. I like Tim Ferriss's book, Titans, because he sits down and speaks to 500 exceptional people doing exceptionally different things and asks them the same set of 10 questions. And it's very interesting to read what idiosyncrasies and random things people do and value who are all successful.
Are you reading that at the minute?
I've read it. I've not right now.
Okay. It's ironic because I'm rereading at the moment.
Fantastic book.
But I picked that book up in parts because it's so dense that you think I can't read 100 pages. I need to read 10 pages and actually implement some of the stuff. But serious value. And that's been around for years. That's why I was intrigued that you brought that one up. Okay, perfect. What's a question that I haven't asked you that would have been valuable?
A question you haven't asked me that would have been valuable. That's a very tough question. I think you've covered everything.
I try my best. That was me giving myself a backhanded compliment. And what advice would you give to someone at the beginning of their journey starting out?
Don't be afraid to ask questions. Ask as many questions. Primarily, that is what my job is as an accountant. I say to people, the value you will get from me is asking me questions. There's no such thing as a stupid question. If you're just starting out, what you need is information and it needs to be correct. So validate by making sure you're listening to people who are validated and ask as many questions as possible. Because soon, in 3 or 4 years, people will be asking you those questions and you can pass it back down.
Love that. How useful is it in your role as an accountant, seeing hundreds of different people's returns to understand what makes a business good? I mean, because I guess one thing I want to put perspective on here is we're not just talking to you as somebody who owns your own business and has your own property portfolio. We're actually talking to you as somebody who has insight into hundreds of businesses, hundreds of property portfolios. Is that useful information to you?
Hugely. So I know exactly what works, but what I would find, what I tend to find is it's the people, not the business. These businesses are all very good businesses. We work with business owners who come to us with good businesses. We don't want to work with people who don't have the ability to make a success. It's the things we covered. It's about taking bold, immediate, massive action to get things started so you can have this cycle of learning from the things you are doing. Because we are all different. I know now, through my experience, who I am. I didn't know 6 years ago. I was a lot more isolated. And now I meet other business owners doing massive things. And I think, oh, I understand now because I took the plunge and I did things that scared me. And different things scare different people. And especially when it comes to property and business, who teaches you this? Nobody. What is super key with business specifically, less so property, because property investors are quite an included community. They like to talk about what they're doing. I have an accountancy firm. I speak to 6 or 7 other accountants who are around my age with firms from 100K to 1 million to 2 million. We're in a WhatsApp group. Any questions we have, who are you using for this? How much are you paying for this? What was your profit this quarter? We freely share all of this information because it comes back to us and we look at each other's profit and losses and balance sheets and, what are you paying for staff? So if we go down that route, that's what the numbers would look like. If you find people like that and you have to be able to put yourself out there too, you will gain so much time because you won't have to guess. You will save yourself 10 years in trying. So the business owners who are closed off and they think, I've spent a year learning this, I'm not going to show anybody. people don't care. There's people doing 10 times what you're doing who would simply tell you that over lunch if you just said, hi, can I have some help? Because they were there once. If somebody says to me, I get lots of Instagram messages from young entrepreneurs, and I can literally see that was me 15 years ago. Sometimes I call these guys and I say, 15 minutes, what do you want to ask me? I don't get anything from that. I do selfishly because I think it's nice to pass back down, but I had a few people do that to me. I also had many people give me really bad advice, and looking back, they were successful. And I don't know if they did it maliciously or they just were too cautious and they didn't want me to go and do the things I was doing. But I spoke to a few people when I was thinking about building the portfolio, and they basically said, don't do it. This is why. Meanwhile, they own blocks of flats and they're doing very well for themselves. And I still don't understand why, but I was so young compared to where I am now, knowledge, wisdom, time. If I'd listened to them, I wouldn't have done what I'm doing now. And I love what I'm doing. I feel like I'm in a place where I need to be. I really enjoy it. It's not a business. It's a community. It's a group of businesses. It's like-minded people. It's really important that you ask people for help.
Love that. And last question, because I'm conscious of your time this time round. What is a quote that resonates for you?
It's quite insidious, but I think it's important. Lots of people want to see you do well, just not better than them.
That's an interesting one.
Yeah, not as motivational, but it's important to be conscious.
It's an interesting one. That one, I think, is context dependent. I think that applies to the broader public.
Mm-hmm.
I think that's one of the reasons why I wanted to build a community,
mm-hmm.
because of that.
Well, that's why communities are so important, because they're like-minded people.
Correct. I think that what I found, even locally, right, is exactly that. So I've always been very private as much as I can as a public-facing person, but very private in what I do specifically,
mm-hmm.
and that I've felt that. Want you to do well, not better than. However, I don't feel that in the property, like in the academy. I don't feel that.
No,
I don't feel that at all. I feel like people will celebrate one another's wins. There is a little bit. Sometimes people compare someone else's step 200 to their step 1,
mm-hmm.
and so I'd invite people to not compare to the extent that it demotivates you, because everyone's journey is unique. But I don't think they don't want those people to do well. I think that sometimes people get a little bit, I feel like I'm getting left behind.
I think the two things we're talking about are different. What I mean is, in general terms, with the average person, it's something to be conscious of. In the same way that the biggest detractor from you actually doing something is speaking to somebody whose opinion shouldn't matter, doesn't matter, but you make it matter. Though a lot of those people.
I've got to follow up a question on that then, because I feel like this is, sorry, James, I promise I'll finish soon. I've got to follow up a question on that because I want to take something that's valuable for people, and I feel like there's something to this, which is your business, but I also want to extract or elicit the value. How important, to put this a different way, how important is it to have the right people around you when you're trying to progress and achieve?
It's the only thing that saves you time, and time is all we have. It takes 10,000 hours to actually successfully master something, but you can use other people's time and experience to speed that up.
Not just their experience, though. I mean, in the sense of how important is it to have people around you that do want you to win, or people that aren't criticizing what you're doing, or people that aren't planting seeds of doubt, or aren't projecting their own limitations onto you.
Mm-hmm.
How important is that? You touched on you are the sum of the 5 people you spend the most time with.
Yeah.
I've had conversations with quite a few people on this podcast, and there's a similar theme that ties into what you're saying, and I feel like I'm detecting it there, which is at some point, a lot of people I've spoke to have had to almost let go of former relationships, form new relationships that allow them to thrive. Is that something that you've experienced?
That is absolutely key. So what I say is, you need to meet people where they are rather than try and bring people along with you, because everybody's happy doing their own thing. So some of my best friends now, and the people I spend time with and I speak to now, they had already got to where they're going before they knew me. We all had our past, but we're meeting at a pinnacle where, okay, this is what we're trying to do now. This makes sense now. Whereas previously, it wouldn't have made sense. We maybe weren't, I don't like the word wise, but maybe we weren't wise enough, or we didn't have enough experience to contribute enough to that relationship, or you didn't want to do those things to be valuable. So I think meeting people where they are, rather than trying to bring everybody with you, is a much more efficient way of doing it. And that's specifically how the closest people I have now and the people I spend my energy and time with, which is the main asset. Yeah, that's your community.
All right. Now, I'm going to have to wrap up because otherwise I'm going to get dragged out of the studio. So I'm going to say, John, thank you very much for sharing and imparting thousands. I mean, you said it at the beginning. I like that. You can save thousands of pounds in a sentence.
Mm-hmm.
You potentially save people tens of thousands of pounds. And potentially, we've not just touched on the tax, but we've also spoke about the investment arm and a lot of the aspects surrounding that, the finance, the mindset, the network, the education, all of these things. So thank you very much for taking your time to share with everyone. And let's do it again.
Thanks for having me.
You're welcome.